Good morning, ladies and gentlemen. We are right at the top of the hour, so in the interest of being respectful of each and everyone's time, we're going to go ahead and get started here. Just a few housekeeping notes as we let a few more people get logged in. Today we're going to be covering the third installment of our Demystifying Indexed Universal Life, or Demystifying IUL series, talking about compelling product features. Just a little housekeeping, everybody is on mute. There is a question section on your dashboard where if you do have questions, you can certainly type them in. I'll do my best to get them answered before we wrap up the session today to the best of my ability. But certainly we'll have folks calling to follow up on this session with you as well. Why do we do these sessions? I want everybody to just, before we get started, just clear off your desk, think about why we're here. We certainly don't do these on a Tuesday and Thursday basis, so I have someone to talk to because nobody's talking back to me anyway. But we do these so we can all get something out of it. Whether you're an insurance professional, an agent, or whether you're a life marketer for a partner office of ours, we do these to give you guys some insight that might be the tipping point in this case to get that agent or that client who's a little bit reluctant about indexed universal life to see the light, to see the great features and the great points that IUL can bring to their business and in a client's perspective to their financial portfolio. So we're doing this for a reason. Please put some time, put some thought into what clients or what agents you think might best benefit from this, because we're hoping you can take away some nugget that is going to help you drive that next sale or that next good contact with your agent or with your clients respectively. So without further ado, we're going to go ahead and get started. Make sure my controls are all working here. Oh, there we go. Compliance has a fairly lengthy hello for everybody. We know how this stuff is important. There's a lot of legal stuff in there, so I make a little joke, but it is important that we have all these disclosures in here. Our agenda today, as we dive into compelling product features, today we're going to talk a little bit about some specific indexing talking points. We're going to talk about some broader product features, and lastly, some additional benefits that you're going to find within the North American IUL portfolio. So we'll go ahead and dive straight ahead into that, starting off with our index talking points. We're going to hit index selections. We'll talk a little bit about our daily sweeps and what that is, and we'll talk a little bit about requirement of money in the fixed account. So let's take a quick look here at the index selections that North American offers. In addition to having some broad crediting methods, we have several index options available. And you'll notice within the annual point-to-point S&P method, our standard 100% par selection, which is kind of your normal S&P annual point-to-point. But we also have a high par selection with a lower cap, and that currently being 140% par with a cap at 10%. And then that annual point-to-point with a spread. So there are, as you can see, 10 different index selections available, and you can mix and match those options any way that you see fit. You're not required to round 5 percentile or 10 percentile or whatever in any specific index option. You can have them split up, if you wanted to, 99% into the S&P annual point-to-point and a 0.1 percentage point into the uncapped S&P. However you see fit, however your client sees that they want to split those selections up and those allocations up, they can do that. So it provides your clients a lot of flexibility there. In addition to the different index selections, we also offer daily sweeps. And I think this is a really important point because I don't know of any other carrier that does it this way. And what daily sweeps means is how often your carrier is actually applying the premium dollars to the chosen indices. Is your money going to work for you when you put it in there, in other words? When your client pays a premium, How long is it? Is most people assume, often incorrectly, that when my client pays the premium dollars, those premiums are allocated to the indices that they've chosen immediately. That's not typically the case. In most cases, they're going to sit there till the end of the month, till the end of the quarter, and sometimes even longer before that carrier applies them to the indexes that are chosen. And to my knowledge, North American is the only carrier that does that on a daily basis. When your client pays those premiums, as soon as those dollars are allocated to the account, they are allocated to the chosen indices. They do not sit in a fixed bucket for even one day. And again, with most carriers, this is something that's taken for granted. Most people assume that's how it works, but that's not the case. It's going to sit in a fixed bucket earning whatever interest rate that fixed account may have for a few days, maybe, up to the end of that week, to the end of that month, in some cases even to the end of the quarter. So it's, again, a little deeper dive, something to think about as you're choosing the index product that you want to be presenting to your agents and to your clients. This is a nice little nugget that you can tell your clients, hey, when your dollars go in, when your premium dollars go in to pay for this, they're being allocated as soon as possible. The last thing we want to talk about here within just specifically indexing talking points is our fixed account. And I alluded to this earlier, but a really key feature with North American's products is that we do not require any allocation of those premium dollars to the fixed account. And this, again, just comes back to, does the client want control of their money? Do they want to know that everything that they've chosen is operating the way that they assumed it would? With a lot of carriers, regardless of the index selections that are chosen, a small amount, a set percentage is going to be held into a fixed account to pay for the charges within the policy. So 100% of the premium dollars or of the money allocated is not going necessarily to their chosen indices. With North American, that's not the case. 100% of the premium is being or can be allocated into the indexed accounts. We do not require anything to be held in the fixed account. Certainly we have, I won't say the same, but similar charges. We have policy costs that have to be taken care of. We just don't require that the money be held in a fixed account to take care of that. So your client absolutely has the opportunity, in addition to those 10 indexes we pointed out earlier, to put money in the fixed account, but they are not required to, nor will there be any money held automatically in a fixed account. So that wraps up our indexing talking points. I want to talk now a little more broadly about some of our key product features in general. And we're going to touch on index rate crediting on the beginning of year value. We'll talk a little bit about our interest rate bonus and standard loans and variable rate loans as well. So let's dive headfirst into that. First off, North American credits interest on the beginning of year value. And I want to draw everyone's attention here. If this is new to you, if you take away only one thing out of today's session that you think, boy, this is a little piece that I can share that with my agents or with my clients that it's really going to impact the way they view IUL and North American's IUL specifically, take this piece away. This is the one nugget I want everybody to grasp. North American is unique in this, in that we credit interest on the beginning of year value. Most people don't think about that. They have an assumption one way or the other, but here's what this means. Our interest being credited at the end of a policy segment, regardless of what policy costs came out throughout that year, our interest being credited is being credited on the beginning of your balance. So let's put that in perspective. If you have a policy with a value of $10,000, with that bucket throughout the year, there may be $1,000 round number, $1,000 in charges taken out. At the end of that segment, you have now $9,000 left. Say that you returned, that bucket returned 10%. You're going to get 10% credited to that $9,000, which is $900. That's going to be added back to the account. With North American, we look at your beginning of segment value rather than after the charges have come out. So your $10,000 starting value is what we're going to apply the interest earned to. So with North American, at the end of that segment, if you earn 10%, you're going to get $1,000 credited back. That's 10% of your $10,000 starting value. That may seem like a little, $100 difference here or there, but think about this broadly as these account values continue to grow. And then think about what happens when these account values grow. We're building, in most scenarios, if you're using something, an accumulation product like a builder IUL, you're building this towards some future need. Maybe it's retirement, maybe it's some kind of gap coverage where you're going to want to draw in a distribution from it. Well, at that point, your clients may be in their 60s, maybe in their 70s or their 80s. How detrimental is that cost of insurance going to be year over year? We know cost of insurance and those charges are going to grow with age. So that $1,000 of charges throughout the year may be significantly more each year as your client ages. Just think about that, exponentially, how much of a difference this is going to be when we're crediting interest on that beginning of year value rather than the end of year value, regardless of the cost of insurance charges taken out throughout the year. That, I guarantee you, should make an impact with your agents, with your advisors, and your clients, as much or more than anything else I'm going to tell you today. This is why our products perform so strongly throughout the long run, without having to have, an assumption of maybe this bonus might happen or maybe this might happen. This is the bare bones of why North American's products perform so well in the long run, is that we're crediting interest on that beginning of year balance, always giving your clients that extra push in their account value. So hopefully that resonates with all of you. Next thing I want to talk about within the product features is the guaranteed interest rate bonus that's available on our products beginning in policy year 11. Now, this benefit provides long-term cash accumulation potential that's contractually guaranteed into the index accounts. For our builder and our guarantee builder IUL, this kicks in at year 11. For our rapid builder, this kicks in at year 16. And again, contractually guaranteed on the indexed account, your clients are going to see a bonus of 0.75%. Year 11 on the builder and guarantee builder, year 16 on the rapid builder. 0.75% contractually guaranteed on the indexed account. It's conditionally guaranteed on the fixed account, and there, obviously are some conditions that have to be met. But if your clients are indicating or allocating into the index account, to know that ultimately their floor beginning year 11 or in the rapid builder year 16, their floor now raises from 0 to 0.75. That bonus is applied after caps, floors, and participation rates. So again, prior to year 11, they have a 0 floor. After year 11, effectively their floor raises to 0.75%, and that's applied after caps and pars. So say this product has an 11, whatever product you're in has an 11% cap. Maybe that year the index, if they're all in one index, returns 17%. Well, it's capped out at 11. So that's going to be the amount that they're earning, crediting. But if they're post the 11th year in the builder, they're going to get an additional 0.75 on there. So they're going to see an 11.75 index credit to their index account. Again, I can't say enough, contractually guaranteed. That interest rate bonus is something much different than you're going to see with other carriers that have conditionally guaranteed bonuses on their index account. A lot of times you ask them, well, what are the conditions that have to be met to get that bonus? And they're going to tell you it's company it's their decision to meet or not choose to implement that bonus. So with North American, you know that it is contractually guaranteed. In addition to that, I want to talk just briefly about loans. Standard loans are available in the first year with a loan rate set by the company. Current loan rate is 2.75% minus interest, credit rate of 1.5, giving you a 1.25 net cost in years 1 through 5. A 1.25 net cost in years 1 through 5. Beginning in year 6, we have net cost zero loans, where the interest rate is equal to the crediting rate. So starting in year 6 and beyond, you have net cost zero loans. In addition to that, we'll get to that in a second, but standard loans offer you, again, a 1.25% in years 1 through 5 and a net zero cost loan in 6+. And that accounting value, again, that for those standard loans must be allocated to the fixed account. Let's talk on the flip side of that about variable loans. North American offers a variable interest rate loan on their indexed universal life products. They are available again in year 6, just as the net zero cost starts on our standard loans the same year. Beginning in year 6, variable loans are available. They are capped, contractually capped at 6%. Currently, we're in real life, our loan is at 4%. For our illustrations, we illustrate 5.47, just based on look-back guidelines built into the product. So we're illustrating 5.47. It's capped at 6%. It has a floor of 3.5%. It's also important to know that this offers flexibility for your client, that they can switch between a variable loan and a standard loan, or a net cost zero loan if they're after year 6 at any point as well. So we're going to carry that full balance over between the types of loans, but we do not require a cash payoff. The balance would be transferred to whichever type of loan you're moving towards, you're moving into. So if they're in a variable loan and the client says, you know what, they're in year 7 or 8 and they decide, I would much rather just bank on having a net cost zero loan, they can transfer that loan value without a payoff into a net cost zero, into a fixed standard loan, and at any point, and vice versa. If they're in a standard loan and they decide in year 6 that they want to transfer that loan value into a variable loan, they can certainly do that. Offers a lot more flexibility and a lot more capability for your client when they're in in the distribution phase of their indexed universal life product. All right, that wraps up talking points and product features. I want to bring us home here talking about some additional benefits that are built into our indexed universal life products. Excuse me. We're going to touch on overloan protection benefit, our unique protected death benefit feature, and then lastly, our chronic illness accelerated death benefit. What is the overloan protection? This is essentially some built-in protection for your client. As we talked about earlier, most of these products, if you're using something like a Builder IUL or a Rapid Builder IUL, they're primarily, obviously, for that life insurance coverage, that death benefit protection, but secondarily, they're being funded to some end to a distribution phase. That's what these products were designed to do, is provide death benefit coverage with the potential for distribution down the road. So if you're getting to that point in retirement where they're taking distributions, we know that with life insurance, the wonderful benefit of loans within a policy is that they are generally going to be tax-free. We know that the death benefit is going to be tax-free. But what happens should your clients get into their distribution phase and all of a sudden they've overloaned the policy? If it lapses, all of those dollars beyond basis are now going to be, anything taken out of it beyond basis is now going to become taxable to your client. Certainly not something that you as an advisor or your client ever want to run into. So that's why products like ours have an overloan protection. Beginning in the 15th policy year, if the policy's been in force for 15 years and provided your client is 65 years or older, your overloan protection is available. Now, I'm going to throw some numbers in here, but all we ultimately need to know is that this benefit is available if the policy has been in force 15 years and if the client is 65 or older. There is no additional cost for this at issue. This is something that's built in automatically. If your client has loaned 89% of their account value and they're between the ages of 65 and 74, this benefit is available to trigger. If they're beyond the age of 75 and they've loaned 93% or more, this benefit is available to trigger. And what it does, essentially, should your client get to that point where they're in danger of overloaning this policy and creating a potentially taxable scenario, this benefit can be elected and it shuts down the policy. It locks it down. Now, the result of that, of course, is your client's death benefit may not be what they thought it was at the beginning. It's going to be based on some minimum figures allowable based on the account value that's still in the policy and minimum death benefit regulations for the product itself. But it saves your client from a massive headache of now having this taxable income scenario that they were not planning for. So the overloan protection is built into this policy, no additional costs at issue, and it's just a great safety net. Oh my gosh, I can't believe we're in this scenario. Here's a safety net built into this to help save your clients a lot of headache down the road. And North American will notify your client when they've reached those thresholds that this benefit is available to them, and that should they choose to elect it and trigger the overloan protection. Taking that concept a little step further is our unique protected death benefit feature. This is, in a lot of ways, very similar to our overloan protection, but it brings the added benefit of client control. Instead of, again, with the overloan protection, it's sort of a safety net, sort of an oops, I can't believe we got to this point. The protected death benefit allows for a similar structure, but it allows them to choose at what point they want to, I'll use the term, lock that policy down, what point they want to stop and retain X death benefit. So say your client maybe has $1 million life insurance policy. They're taking some distributions. They may get to the point, for whatever reason, where I want to continue my distributions in this policy, provided that I can, but I want to make sure that I'm never putting at risk any more than $500,000 of this death benefit. I want to maintain this $500,000 that I'm going to be able to pass along tax-free to my children, to my heirs, or whatever the situation may be. They can proactively trigger the protected death benefit, which locks it down at a specified death benefit amount. And then, provided the account value and the funding is still appropriate, they can continue to take distributions from that policy. So it's a fantastic, not so much a safety net as it is a proactive effort to say, I want to continue my distributions, but I want to make sure that I'm never putting this death benefit in danger of dropping below X amount. And again, like the overloan protection, this is available once the policy has been in force 15 years and once the client is 65 years or older. Just a great proactive benefit that not a lot of, to my knowledge, not any other carriers offer. And it takes it beyond that safety net feature of the overloan protection into something that gives your clients one more piece of control, one more piece of something that's within their power to control within that policy. Lastly, I want to talk about accelerated death benefit endorsements. Built into the North American policies, again, at no cost at issue, are terminal, critical, and chronic illness. I shouldn't say again, but I do need to specify this is not available on the survivorship product in the same way. So we're talking specifically about single life index universal life products right now. As I said, these accelerated benefits are no additional cost, no additional premium at issue. They're issued automatically, except in, I have to say, in California. As we all know, they're a little tighter on things like this, where the benefit does have some minor additional underwriting requirements. Otherwise, they're issued automatically with no additional premium at issue. This brings in another great benefit for your client, and that there's control. They control how much is needed, provided your client meets 2 of those 6 ADLs. If we're talking about chronic illness or terminal or critical, provided they meet the guidelines to trigger the benefit, they control how much is being used. They're not forced to take X amount out of this. They can use up to the limitations of either the critical, the terminal, or the chronic illness at the time that they choose to use it. Talking about qualifying for the chronic illness benefit a little bit, I alluded to is provided they're unable to perform 2 of the 6 ADLs or activities of daily living, or that the client suffers from a severe cognitive impairment that requires supervision, they can trigger that chronic illness benefit. It's something that it's paid out on the provisions are paid out on an annual basis. So there's an election every 12 months. The client can take up to 24% of the death benefit, or $240,000, minimum of 5% or $50,000, but we must maintain a residual death benefit of $10,000 in there. It's important to note that while this fantastic benefit, this fantastic flexibility is available to your client, this is not long-term care. This is not intended to replace long-term care insurance. It's a great gap benefit. It's a great benefit built in for clients who maybe cannot afford additional options. It just offers some great flexibility to accelerate that death benefit for a multitude of reasons in their living years. Now, as I said, this is available at no additional cost to your client. At issue, there is a $200 administration fee upon each election, and it's important to note that the death benefit does have a the word is escaping me. Does have a discount factor applied to it. It's a time value of money calculation that we use because we're accelerating death benefit in the living years. So the amount that the client accelerates isn't going to be the exact amount that they get. I think you'll find this sort of acceleration is par for the course. Either you're paying a substantial fee on the front end for a benefit that you may never use, or in North American situation, we don't charge you anything, but there is a discount factor should they use it, should they elect to use it at some point in the future. Just another great benefit that adds an additional piece of flexibility for your clients and for your agents to market this. So to summarize, we talked a little bit about some different indexing talking points, 10 different indices available with crediting methods, giving the client the control that they want, in addition to the fixed account. We talked about we don't require any money in the fixed account, but it is certainly there for them should they choose to go that route. Talked more broadly about specific product features that are tailored to meet your client's needs. I think I hammered on the point about the way that we credit interest on the beginning of your value, and I hope you take that nugget away from this presentation, because it's something that's very unique and extremely beneficial to your clients and to agents as a talking point and a marketing feature. And lastly, we talked about the additional benefits built in automatically to our products, our overloan protection, our protected death benefit, and our chronic, terminal, and critical illness needs. Just extra tools, extra flexibility to help your clients meet the needs and and the expectations that they hope to get out of their life insurance product. So the bottom line is this: with North American, your client is getting flexibility and control of their policy that's unprecedented in the industry. We're getting products that are tailor-made to help meet your client's needs, as well as the death benefit protection they need to be leaving those benefits to their heirs. You, as an insurance professional, as an agent, or as a marketing professional within a partner office, you get a line of competitive products that is second to none that can help your agents and help your clients meet their needs. As I said at the beginning, we don't do these things every couple of days just so I have someone to talk to. We do these to help spur, to help spark that next sale. Whether you're an insurance professional, an agent, or whether you're a marketer looking for ideas to bring to your field force, we do these things to help drive additional sales. So I want you to think about your next 3 clients. Think about who it is that could benefit from a product like the North American Index Universal Life. Who it is that these features we talked about today are going to be the tipping point to get them to see the light. Yeah, IUL really is a great option for me. Yes, this is what I can do to help protect my family and protect my children and offer me some unbelievable flexibility and benefits in the future. We're going to have our marketers from our team here calling and following up with each and every one of you and answering any questions you might have regarding our products. And we encourage you to take this, think about those clients, and figure out a way that we can help position North American as a solution for your clients. As I wrap up, I'm going to take a quick peek to see what questions we have here. I beg just a moment of your time while I read through these. All right, I think we got most of these answered. And again, we're at about a half hour here, and I want to be respectful of folks' time. If I didn't get your question answered to the degree that you were hoping, please give us a call, or as the marketers here reach out, please make sure you raise those questions with them. I think for the most part, these questions, we've got them answered. Otherwise, again, we'll address those directly with you on an individual basis. Folks, thank you so much for your time today, for carving out a half hour in your busy day. We know that time is money, and we appreciate you investing the time to learn a little bit more about North American Index Universal Life products. We look forward to helping you with your next piece of business, and thank you so much for working and partnering with North American. Have a great day.